actually cost you a lot of fun.
The cheese balls.
Pretty cool.
Okay, here we go.
It worked.
Welcome. You're listening to the Best of Investing on Talk 910, the show where we present valuable information about real estate, the financial markets, and other economic business of the day. And for those of you listening for the first time, here's our format. A few guys sitting around a bar having drinks without the drinks, talking business with you, the audience listening in. I'm your host, Edward Brown, and I'm pleased to have as my co-host Mark Hanf of Pacific Private Money, California's fastest growing private lender, and Lou Batmale of LPL Financial. Our phone number is 888-912-1190. Write that number down, 888-912-1190, because you're going to use that number to answer the trivia questions for 3 vacations given away during each commercial break. That's right, we're giving away 9 vacations during this show. Now, the vacations are not sponsored by the radio station, but by Lighthouse Resort and Marina, which is located 1 hour northeast of San Francisco. The vacations are free. Their only request, a $75 cleaning fee to cover housekeeping expenses. Their website is lighthouse4fun.com. Check them out. You can reach them at 916-777-5511. And today's trivia theme is Jim Carrey movies. You have fun with this one. Okay. No, if you go, hey, that's Fonzie, so that's different. Our website is bestofinvesting.com. Check us out on Facebook and YouTube by typing Best of Investing Radio Show, and check us out on TV. We're somewhere on there. Okay. Now, we're going to get right into this. Lou, we got an email that was right up your alley here. It says, with interest rates low, potentially on the rise, what do you think of investing in muni bonds or a muni bond fund?
Okay, well, that's a great question. It's been a kind of a challenging week because we've seen a lot of economic data come out. I think this week, well, we had the Twitter IPO, then we had interesting jobs report, GDP was growing. So everyone's kind of, it really gets to the crux of the point about bond investing. That is, what do I do when rates are going up? And what's going to cause rates to go up? I'll get into that real quick because people don't understand bonds. There's an inverse relationship. If you look it up on the internet, you get no clear answers. So let's try and make it clear for everybody. So there's no resources. So, as it's been a difficult year for bonds, it started back in June when we heard that things might change. So I want to talk really quickly. You see, frustrating. We talk about the stock market. So the S&P 500, which represents part of the stock market, is up over 20% this year so far. That's as of like November 7th, 2013. I won't put a date on that. Surprising, as many things have stimulated the market, but in the past we have seen modest returns. If you look at the Barclays Ag, which is a bunch of bond indexes together, that invests, mostly investment grade bonds, it's down this year so far, maybe down 3 to 4%. So actually I bought a chart, we're not on TV, but I'll pass around to you guys, that shows you the red line is the stock market, the blue line is the bond market. Oops. And everyone's sitting there going right now. So, for those listening, the red line's going way up, the blue line's kind of staying flat or going down a little bit. So people didn't lose, a ton of money in the bond market compared to what people lost in the stock market, let's say in 2011 or something like that, when the market was down 20%. So the stock market can go up or down 20% in a given year. The bond market usually goes up about 6% or down 6% every year. Since 2008, when this lovely economic calamity happened, the bond market's been doing pretty well and going up every year. So because people wanted something that's more secure. Bonds are more secure than stocks.
And so as they purchased the bonds, the bond prices went up
and became more popular. So most feel that the bonds are less volatile. That's why they buy them. Some people say, they have quotes and stuff, they're like, well, you should invest the amount of bonds as your age is. So if you are 50 years old, you should own 50% bonds. I don't agree with that theory. I think that lexicon has changed a little bit because of what's happened to the returns of the market and what the government's doing to manipulate things. But there's been a change in long-term rates, and what that does really is it drops bond values. So let me put it very simply, okay? If I'm sitting looking at 2 pieces of paper, and one pays me 3% and one pays me 4%, which one does everybody want?
Oh, pick me.
Oh, yeah.
4%.
4%.
Yeah.
So, well, current bondholders are people that get 3%, right? And future bondholders, if interest rates do rise, have 4%. So all of a sudden, your 3% piece of paper became worth less money. You didn't lose your money; you'll still get money back for it. You didn't fall to zero, but it's just less popular.
Well, and if I hold the bond to maturity, I'll
get your money back.
Money back. But I've got that opportunity cost while interest rates are higher.
Correct. And the whole thing is that inflation now, the cost of a Toyota Corolla has risen every year for the last 20 years. We use the Corolla because it's a consistent car model. It's been around forever. I mean, I think it was under $9,000 back in the 90s, and now it's what $14,000, $16,000 today. So if you invested in a bond back then with the price of a Corolla and took that money out today, you lost all that inflation almost twice.
I
half
should
your
have
money.
invested in a Corolla.
Exactly. Probably still be running.
Well, wait a minute. No. I think the Corolla, if you bought it back then, would have depreciated, probably worth about $150 today.
Oh, that's right.
It's the new one every year.
It's called the second law of thermodynamics. It's entropy. If you leave a car long enough, it'll eventually go down less.
Yeah, exactly. So
down.
what happened this year is that the Federal Reserve, which controls the interest rates in the marketplace, kind of hinted like, hey, we might be stopping our bond buying program that's keeping rates low. That happened, you remember, in the May-June timeframe.
Yeah, we may.
Yeah.
We're thinking about it.
Nothing's happened yet, and people have been trying to predict this for a while. There are people today still going, I think it's going to be the end of 2014. I think it's going to be January. I think it's when Janet Yellen takes over in the Fed if she gets approved. All these different issues are coming to a head. Everyone goes, well, I just know when we're going to change bond interest rates. But no one really knows. But when they hint at it like that, all of a sudden the interest rate change spooks the market, people change, everyone goes, I'm going to pull the money I have that I want to invest in future bonds in cash, which makes the bonds we currently own less popular.
Okay, so just as a simple rule of thumb, as interest rates go up, bond prices go down.
Correct.
Or
that's the inverse
or
relationship.
even if the thinking that interest rates are going to go up, bond prices go down.
Yes, absolutely. So, when this happens, the question becomes, what do I do with my money? Do I own more bonds? Do I own more stocks? What should I own? And the answer really is positioning bonds in your portfolio is a real difficult process. Some people trust professionals to do that. Other people do it themselves. But by and large, you got to look at the yield and what people can do with the investments you have.
Do you like laddering bonds?
Laddering is a good question. So really quick what laddering is just picking dates on bonds and saying, okay, we're going to have a bond that matures in year 1, year 2, year 3, year 4, year 5, all the way up. And that's done a lot with the municipals because it's a very cheap process to do invest in bonds. What bond managers are doing now, that's a fixed investment, right? That's never going to change. Once you buy that ladder, you're married to it. I'm saying because we're all guys. So sorry about that. So the issue really
do you
becomes,
take this bond to be your wife?
Yeah, exactly. This bond ladder is yours forever. Yeah. So I mean, so interesting enough, you bought a bond ladder in 2007. It did great in 2008, 9, 10, 11, 12. And this year, it's like, oh no, I own a bond ladder. That's really what's happened, everybody. They all own these bonds, and all of a sudden, So what you can do is you can own short-term bonds. You can own short-term municipal bonds. You can own short-term corporate bonds or corporate bonds. So look at corporations located in your certain area. Everyone knows who Walmart is. Walmart issues bonds. Chevron issues bonds locally around here. Clorox issues bonds. So some bonds are super popular because they think the credit rating of a company's great.
Okay,
Clorox and Chevron, you're like, they're not
going to go out of business. What's the yield on
those? Those usually are on short-term bonds under 5 years. I think we've seen them in the 3% range.
Fantastic.
Next to barely above the bank. So everyone's now taking more risks, saying I'm going to go buy something maybe with a retailer that's not well funded, like JCPenney or Macy's years ago was one. Goodyear Tire and Rubber's one. Even some energy companies, Chesapeake Energy and others, are considered high yield bonds.
Or even maybe some of the car manufacturers.
Well, car manufacturers is a great story. I mean, you could buy those bonds back in 2008 for 50 cents on the dollar.
Wow, what was the yield back then?
It was like 14%.
Only because they thought, they're going to go under.
Right, how safe is it exactly?
Yeah, no, I saw someone that was holding a Goldman Sachs bond. They go, I paid 80 cents on the dollar. The yield on that thing's like 11%. That they bought back in 2008.
The current yield? Or the yield
No,
to maturity?
their yield to maturity. Because when they bought it, no one wanted it. Again, the popularity contest. Bonds can actually go down in value. When they do, you buy them with higher yields.
Yes.
So a higher yield bond indicates one thing, it's risk. Now, the other thing it indicates is an acronym which is called a junk bond.
Yeah.
Because usually the debt in those companies or the structure of their accounting practices indicate that they're not going to make it or might not make it. Okay. Usually by and large to do that. Now, the funny thing about those riskier bonds, this is the funny part, they kind of mimic the stock market. So the market goes up really high. High yield bonds usually do pretty well. The stock market goes down, high yield bonds go down.
Okay, I'm going to guess because as the stock market goes up, people are considering the economy is doing better shape, and those companies are probably not going to go out of business.
Correct.
Oh.
Risk is off the table. When risk comes off the table, they do better. Perfect example. Thank God you're here.
Yeah.
So,
well, quick question then about the difference for munis versus regular corporate bonds. I mean, most people know the difference. Muni bonds are tax-free, depending on which if the California ones or federal ones, whatever. But just from the standpoint of just are you a fan of muni bonds, and if interest rates go up, what are you thinking? And then bond funds Trying to get to the listener's actual question.
Sorry, I mean, which one do I have to marry? Is that what you're asking?
Yeah.
Muni bonds, I think, are a tremendous investment. The bonds are domiciled in California, pay tax-free interest on both federal and state level.
And especially if excuse me, sorry for interrupting. Especially if tax rates are going to go up.
Correct.
Yeah.
You know, so remember you got the state, local, and alternative minimum tax. Sometimes there's AMT built into these bonds, which is a difficult tax thing we have to get on.
Okay, well, you know what, we're going to cut to a commercial break, and we got to keep
Go back to munis.
Because we want to keep the audience in suspenders.
Right.
Okay, first commercial break here. Again, the theme is Jim Carrey movies. What is the name? Excuse me. What is the name of the 1997 movie where Jim Carrey always has to tell the truth? The first three callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Their website is lighthouse4fun.com. Check them out. Call 888-912-1190. That's 888-912-1190 to answer this question. What was the name of the 1997 movie where Jim Carrey always has to tell the truth? 888-912-1190. Make sure to include your name and your email address. Please speak slowly when you give us a phone call. Spell out your email one letter at a time. Don't touch that dial because the best of investing will be right back.
Okay.
You guys sound haggard after the last show. You guys okay? I'm worried about you. You guys need some more too?
It's more than last night. I was exhausted after last night.
Is he
throat
smoking
starting to
shit?
go, yeah. My voice held up okay the last show. Now it's just like
Lou, back to you.
scratchy.
Yeah.
Lou, yeah, what's your point? Lou, how big's your back? We're going to be carried. Yeah,
Oh God. Adrenaline hangover.
Sorry, I just got to give you some. Yeah, you probably had to remember everybody's name last night. You're jumping through stuff.
Yeah, not so much that. It's just we did like a presentation and then.
Oh, wow.
Well, the days leading up to it, there's anxiety.
Oh, yeah. Do I have a client that's actually suffered from adrenaline fatigue, which is when they're taking care of a sick relative. They're like, your body's always stimulated, overstimulates, and too much adrenaline in your system.
Oh wow.
Doctor says, yeah, it's a scary thing. They're starting to see more of it. So,
Adrenaline fatigue.
yeah. I don't think you have it. I think you have a hangover.
Yeah.
I didn't drink much last night.
I didn't either. I
It's
just
just, well, you're out late, you know, you're off your game a little bit because you're moving around. And you're, like you said, the whole thing is leading up to it's the worst part.
Yeah.
Did you even get a chance to eat?
No. I know. I missed all that good food. I mean, I was thinking because Lisa, we've got a couple of hours to burn. Maybe we'll go down to Piatti's and have dinner.
Oh, free food. I mean, not free, but you already paid for it.
I know. Well, I know. It's just a marketing expense. Whatever.
Okay.
You guys want some NyQuil?
Night night.
Dayquil. Here we go. Welcome back to the Best of Investing. I'm Edward Brown, your host, along with Mark Hunt of Pacific Private Money and Lou Batmale of LPL Financial. When we cut to the first commercial break, we asked this trivia question: what was the name of the 1997 movie where Jim Carrey always has to tell the truth? Lou.
Liar, liar.
Liar, liar.
Liar.
You only had to say it once.
Oh, did I?
No, that is the name of the movie, Liar, Liar, twice. Okay, we are talking to Lou Batmale of LPL Financial because he's quite the investment expert here, and we're talking about, we're just getting into muni bonds, and you were getting into a little bit the difference between munis and the corporates and what you favor right now.
Yeah, no, so who the issuer is, you know, there's corporations, there's governments. The United States government issues bonds, they issue treasury notes, bonds, bills, and everything. But the government backs it. But California municipal bonds, again, they pay interest, and they could be subject to state, local, alternative minimum tax.
What do you think of, do you have any opinion about like Puerto Rico bonds?
Puerto Rico bonds are having some problems right now.
Really?
Did you read about that?
No,
So Puerto Rico is one of the only places, I think there's Guam, there's one other spot, where if you buy a bond, regardless of the state you live in, it's like owning a California state bond. So you don't have to pay state income tax.
Yeah.
So their debt to equity ratio as a country's pretty dismal right now.
Okay.
And their bonds have gone down a lot in value. And even locally here, you know, when you buy a municipal bond, you're buying something on the city, county, the state level.
Okay.
You know, California general obligation bonds have been popular for a while. You gotta remember when there's a vote out there about what do we do about spending money in the state of California, municipal bonds and education are kind of off the table. They always have to pay those. Those are non-negotiable parts of the California state budget. So some people get concerned, like, what happens if the state does this or that? Well, in the end, their charter says that most bonds have to be paid on the general obligation level. But other things are backed by taxes, ad valorem taxes, local school districts and such. And right now we have a lot of headlines. I think we had a show a couple years ago about San Bernardino, Vallejo, and Stockton. Stockton, I think, just settled that their pension's going to be okay. But by and large, these are counties that come up, and if you own a municipal bond there, it is a problem, and that bond's not worth as much as it was when it was originally issued.
Or did they actually stop paying on the interest?
I don't. There are several level of bonds. Stuff that's backed by homeowners' taxes usually are always paid. Yeah. But county general obligation bonds or some school bonds might not be paid. And actually, to negotiate with people on the bigger holders, and a smaller individual holder negotiate on the backs of large institutions that negotiate with the cities about what's going to happen.
Okay.
So just know what you're buying. Like one quote I heard a municipal person say one time that I believe in a lot is, "I buy stuff that's within 7 miles of the coast of California." Those are older homes where people are more likely to pay their taxes on their homes. So if you're flushing the toilet, using the sink, or going to school around there, you're going to pay your taxes, and you're going to get paid as a bondholder.
Yeah, generally you're not going to have, like in the Midwest, let's say, not to pick on them, but as an example, where a whole town, Dust Bowl or something.
Correct. Yeah. These towns are very substantial. They're established. They might be in a good condition where they're rolling into new homes. Like you think of mature areas in the Bay Area, like Redwood City, Foster City, Belmont, those areas. People are buying new. The older generations moving out, the newer generations moving in and paying more in taxes. That's better. Now, the interesting thing I want to talk about that gets kind of captivating is a lot of individuals buy bonds, and this I don't want to say is dangerous, but it's very, very challenging. And I want to explain the difference here. Many times you hear stuff on the radio like, "Oh, hey, this school district or this property group it wants to issue municipal bonds. Okay. Call this investment company." The reason why they do that is because most institutions don't want a small issue. They want to participate in something that's liquid. So liquidity is always a big issue. So you go out there and go, "Hey, I would go buy something in a small little school district in a small town that was just developed in the state of California, maybe in Southern California." Okay, terrific. What's the likelihood they're going to be in business 10 years from now? Well, you don't know.
And try to sell it.
An institution doesn't know. Let's say the issue is $3 million. What institution wants a $3 million bond issue? They're looking for something that's $50 million. They want to go to the city of San Francisco. They want to go to Los Angeles County. They want to go to California State General Obligation Bonds, where there's $50 million, $70 million worth of bonds. And if they ever want to get in or out of those bonds, someone's there to trade it.
Okay, so your feeling is stay away from the small issuers.
Or buying them in an individual basis, on a scale of under $100,000. It could be challenging. You need some help there. Okay. Don't go in there and say, "I'm going to buy a $10,000 municipal bond." You can do it, but you might need some help.
And do you like funds?
Muni funds can be a great alternative because those managers' jobs is to, one, predict interest rates and try and position the portfolio correctly. They have access to stuff that you don't have access to that could be short-term or floating rate municipals. So there's a lot of kind of ways.
Okay, tell you what, we're going to come back to you on some of the others because I know you got a lot of great information for us. Let's move on to Mark because he got an email too, and then we'll kind of bounce back and forth. Okay?
Who? Sure.
Who? Yeah, exactly. You can wake up now. No, I'm just kidding. No, yeah, I know you were paying attention the whole time.
Absolutely.
Okay. So here's a question that came in for you, Mark. How liquid is your fund? So this is someone who's been listening to the show for a long time. You got to kind of give us a little background on what that means.
Unlike what we've been talking about last couple of segments here about muni bonds and bond funds, etc. At Pacific Private Money, I'm broker and president of Pacific Private Money based in Marin County. We have a fund. It's a mortgage pool fund. It's called the Pacific Private Money Fund, and right now it's paying a annualized yield based on the third quarter distribution of approximately 8.9% annualized. And so it is not a bond fund. In fact, it's not a publicly traded type of fund. It's what's considered an alternative investment, meaning you would buy mortgage pool or you invest in mortgage pool funds generally through licensed real estate brokers through the Department of Real Estate or through the Department of Corporations, a California finance lender. There's a couple of ways that mortgage pool funds are regulated, but these are regulated by both the SEC and by the state in which they're issued. And at the Pacific Private Money Fund, We make loans to real estate investors with our capital. There's only two assets in our fund. It's either cash or it's notes secured by real estate, and in our case, by local Bay Area real estate. So we make loans to real estate investors. Typical type of loan we make are to people who are buying, fixing, and flipping real estate in the Bay Area, as well as some small commercial loans. The average loan size in the fund is about $250,000. And so the question was, how liquid is the fund? So the question, if you as a listener were to invest, say, our minimum investment is $50,000 in our mortgage pool fund. How liquid is the fund? Well, first of all, there's always cash in the fund because there's new investment dollars coming in on a regular basis because we do a lot of marketing and promoting of our fund, and it's growing. We're growing it. Our target is between $30 and $50 million, and we haven't reached that target. So we're continually promoting and bringing in new investment dollars, and we make short-term loans, and some of those loans pay off as soon as 90 days. We've got capital that's revolving by meaning that we're lending it out, and loans are constantly paying off. So there's always an influx of payoffs of loans, which result in cash to the fund, and then we've got new monies coming in from new investors. So what that means for a prospective shareholder who's concerned about liquidity is that, well, there's two things. First is, how long do you need to keep the money in the fund? Because most funds have a minimum requirement period, and at Pacific Private Money Fund, it's 2 years. So we ask that if you become a shareholder, you agree to keep your money in for 2 years. After 2 years, there's no fees for redemption. In fact, there's no fees going into the fund, and there's no fees for redemption after 2 years. If you have to take your money out sooner, there is an early withdrawal penalty. Most funds have that. It's not a huge penalty, but it's a penalty.
How much is the penalty? Let's say if I get out after 1 year.
Well, if you got out after 1 year, it would be 4%. Would be the penalty. But if you're earning
8.9%,
you're not going to lose money. You're still actually going to get
4.9%. That's still a little bit better than the bank, isn't it, Lou?
Right, it is. Yes.
So, but after 2 years, then you can make a redemption request, and then we are obligated to at the first of every month to honor all redemption requests that came in the prior month, and so there will be cash in the fund from both redemptions and new capital, and we are obligated to make those redemption requests first before we place new money.
When you say redemption, you mean from loans paying off?
No, redemption request from a shareholder. So redemption meaning if a shareholder wants his money back, we have to pay that. We have to honor that repayment request first before we make a new loan. So it's not liquid in the sense that you can sell it on the open market. You're a shareholder of a fund which is not a publicly traded fund. It's a private placement, as they call it.
I kind of look at it like, when you go to the bank and tie your money up in a 2-year CD.
Yeah.
It's kind of liquid.
It's kind of liquid.
But it's expensive to get out of. It's kind of the same sort of thing.
It is, but after 2 years, the liquidity is that you request your money, and then at the first of the month, we then honor the redemption request. We pay off those people who have asked for their money back. And so it's not meant to be a fast liquidation strategy. And again, I don't know that that's necessarily a negative. So it sounds like, well, I'm backpedaling selling the fund. No, I'm not. It's really, that there are very few opportunities, as we're sitting here talking about, bonds and other types of funds. We're talking about 3 and 4% yields.
All income producing
assets. Right. All income producing. And we all know what the stock market's done over the last 10 years. It's up, it's down, it's up and down. So for someone who's looking to diversify their portfolio and they want to season their portfolio with some high yield opportunities, it's everyone's personal choice as to how much of their investment strategy they want to employ into high yield.
But high yield doesn't necessarily mean high risk.
That's correct. We haven't got into that portion of it, but the high yield opportunities, to be able to earn a secured return of 8 to 9% in today's low interest rate environment, the trade-off being, well, I can't get my money back tomorrow if I need it. I have to put in a request. There have to be the funds available. So generally within 30 to 60 days, you're going to get your money back. So this is not the liquidity portion of your investment portfolio.
Okay, so before we cut to our second commercial break, just give us a quick snippet as to why it's not, high risk.
Well,
And
because
then,
the loans
tell us
we
how to get a hold of you.
because the loans we make are generally no more than 70% loan to value, and in fact, the weighted average loan to value in our mortgage pool fund today is 55%, meaning it is the notes are secured by assets that are worth 45% more.
Yeah,
than
almost
the note value.
double.
Yeah,
Right.
so it's very, very well secured. So this is not, we're not talking about a risky investment. It's a private placement. It's an alternative investment. It's not readily liquid, but the payout is spectacular, and it's one of the best investments I think out there for people who are looking for a high yield strategy or who need a high yield strategy to kind of boost the annual yields and growth of their
So yeah, a
earnings
lot
and their
of
savings
people are
portfolios.
looking for high income because they need
Right.
to support the fact that the other assets are not producing it. How do people get a hold of you?
So Pacific Private Money, we're located in Marin County. We're at 415-883-2150. Again, 415-883-2150. And our website is pacificprivatemoney.com.
And before I forget, we're going to cut to our second commercial break. Again, the theme is Jim Carrey movies. But Lou, you were talking about bonds and munis, and you're quite knowledgeable on this. For the listening audience, how do people get a hold of you?
You can call the office at 415-256-8970. Also, there's a website, LOUISBATMALE.com.
That spells Lou Batmale.
Lou Batmale, yes. But people forget the IS, that's the problem. They spell Lou, so you got to stop there.
Oh,
which I
that's
get,
a good point. Good
right,
point.
so I just want to spell out there. But yeah, you can stop on there and see the show and my contact information. Free look for everybody to analyze things, no problem.
Do you have our show on your website?
Yes, absolutely.
Okay,
Nice.
Excellent. Okay, we're going to cut to our second commercial break. Again, the theme is Jim Carrey movies. In which 1994 movie Jim Carrey, he plays a character named Stanley Ipkiss, but his green alter ego says the line, "Smokin'." The first three callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Their website is lighthouse4fun.com. Call 888-912-1190. That's 888-912-1190 to answer this question. In this 1994 movie, Jim Carrey plays Stanley Ipkiss, but his green alter ego says the line, "Smokin'." Call 888-912-1190. Make sure to include your name, your email address. Speak slowly. Spell out your email one letter at a time. Don't touch that dial because the best of investing. We'll be right back. I remember which show I'm doing. You know, I actually did that on on a sports show.
Yeah.
I said the best of investing. Will be right back. I didn't catch it. Nobody caught it. Told
Editing?
no.
No.
It's still up there, but I didn't hear you guys.
How's the sports show going?
It's going really well.
Awesome.
Yeah, they get really good guests, and it's a lot of fun.
All checking our emails. This looks really good online. I'm taking a commercial break. We should play some music.
Yeah,
Play the national anthem.
there was
How are we doing on time?
pretty well. Between the two, we've got a little less than 18 minutes to go, so that'd be kind of fairly short. It's like fairly short.
What do you want to go into next? Do you want
There was one, just a very quick thing I read about credit card fraud that I thought was kind of interesting.
to about the cop in not so long ago? We heard the police officer about identity theft we run in.
Yeah,
Yeah, that's good.
so this was just a quick little thing, and then do you guys have something specific?
I can go into inventory and why things sell slowly.
Okay.
Might be good for people.
Inventory?
That's people don't understand. Stocks and bonds have inventory. Big issues. So I'm trying to buy in this small company up in Petaluma. I'm like, it's hard to buy. Like, no, it's not. Like, yeah, it is. If you want to buy 5,000 shares and it trades 500 a day, it's very hard to buy.
Okay,
What did Twitter end up today? It's some
Up
ridiculous
73%,
overprice.
$47. People weren't buying a lot. One guy downgraded it. So he came out today, some guy downgraded the stock.
There you go.
So they have a revenue model. I mean, the thing of Facebook is they built a revenue model after they went public. So
Yeah.
that's what they're going to have to do, but no one knows how.
That's not a good thing. Okay, ready? Here we go.
How more millionaires are there today than there were yesterday?
Welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Hunt and Lou Batmale. In the second commercial break, we asked this trivia question. Again, the theme is Jim Carrey movies, in which 1994 movie Jim Carrey plays Stanley Ipkiss, but his green alter ego says the line, "Smokin'." Lou, what's the answer?
Cameron Diaz.
Yes.
The Mask.
What's
The Mask.
The Mask, that's right.
Yes.
And who can forget the line, "Kiss me, my dear, and I will reveal my croissant. I will spread your pâté. I will dip my ladle in your vichyssoise." Okay, Hollywood, if you need to call me to
Exactly.
stand in for Jim Carrey, there I am. Which, by the way, we have the same birthday.
Really?
Yeah, he's 2
That's
years
not
younger than
shocking.
I. Yeah. Okay, Lou, you wanted to talk about inventory.
Okay, so we touched earlier on bonds, and one thing that drives bond and stock prices is the demand. And one thing that people understand, I've been having a lot of conversations lately, as things have gone up in value and people are talking about moving in and out of bonds. One issue that comes along is something that's traded on the S&P 500. Name one of the big stocks out there. There's probably 50 institutions participating in that one trade. You sit there and say, I want to trade this stock for $30.50. You have 50 respondents to that request. If it's a big company, if you have a small regional bank, those are publicly traded, or a smaller company located in the Bay Area that maybe has 100 employees. You go, hey, I want to go invest $10,000 or $5,000 in that company. You go up there and you go, well, geez, it trades about 500 or 100 shares a day, maybe.
Are you talking about like a market maker?
Those are like market makers,
Okay.
right? So people understand when they get to bonds, it's even worse. When I go and price a bond with deal makers or market makers of bonds, there's usually 3 participants. So you can have a great bond in a great city, and you're sitting there going, well, geez, I have this person who passed away, or this person wants to trade this bond for $20,000. You're like, I'm not getting a lot of interest, man. I don't know what to tell you.
God, that sounds like you can get manipulated.
Well, I say this. You have to be careful on the bond side because you can get fleeced. You get fleeced because people sit there and they hold the stuff in inventory. They price it up wherever they feel they can get it for, or they buy it for where they think they can get it for and sell it to someone else much cheaper. And these people know what's going on. That's the problem. You don't know the other side of the trade. Now, again, in stocks on big companies, this does not happen.
Because there's enough competition.
Enough competition that drives the market. But when you have a little small issue, like I mentioned, a little small community college district that has a bond and not a lot of participators in the institutional level, who's going to trade it? You got to find someone that wants it. And that's the kind of the problem. The stock side, the same thing.
So there's a liquidity issue, is really what you're saying.
It is
that
liquidity.
There's no guarantee that you can get out of these. And I think there's a lot of presumptions by people that if I buy something that's publicly traded, by definition, I should be able to just sell it tomorrow when I need the cash.
There was an old joke where this one guy, a stockbroker, goes ahead and tells his client, "Hey, buy 100 shares of ABC company. It's going to go up. It's $5 a share." He goes, "Okay." And then that 3 days later, he goes, "Hey, you should buy another 100 shares." He goes, "Why? It's up to $8." Okay. And then this goes on. It keeps going up and up and up. Finally, stock's at like $50 a share, and the guy's got 1,000 shares, and he says, "No, just sell everything." He goes, "Sell to whom?"
Right. Nice. That's the problem, is that people inherit these positions from their grandparents who invest in little small banks or have municipal bonds from years and years and years ago. Most municipal bonds go out 15 years, 20 years, so people hold them for a long-term investment. Or even, most corporate bonds are a little shorter in their maturities, but you have to know what pool you're swimming in and what's going on. That's why you might need the help of an investment professional to analyze and ask these questions. I had someone this week who says, "What's this thing in my portfolio?" I go, "It's a sinking bond fund, municipal bond fund." "What's that?" I'm like, "Well, actually, you don't have to worry about it. It's getting redeemed right now." And we're seeing a ton of that in the marketplace. The municipal market is so popular right now that people are saying, well, I can go get, as an issuer, I can issue a lower interest rate, and people are still going to buy because everyone wants the tax-free benefits of investing in municipal bonds. So I'm going to call in the bond that pays 4.5% and issue one that pays 3.5%. That's what's going on right now in the municipal market. It's very challenging.
Do they have to have the money first to pay off the?
They do. That's why they have those special elections all the time. That's where they're coming from. That's what they're trying to do, is fund those bond purchases and recapitalize at a lower interest rate.
Then why do us voters keep voting for more sales tax?
I don't know. That's probably. I mean, I know we're on Rush's station. We probably should give him a call right now and ask his opinion. But by and large, the thing is that you run into this problem where, as we're voting for more and more things, we're paying out more and more money. We're borrowing the bonds and paying more interest, and we got to redeem these bonds at some point in the future. It's like, it's like the federal government. We're banking it for later, and we got to pay it off. So
wow.
it's kind of frustrating.
How much of a concern, Lou, is there still out there? Because I heard, we heard this a lot 2 years ago. In fact, in the earlier shows that we used to do in 2010, 2011, we were always talking about, the ticking time bomb of muni bonds. And is that still as much of a concern today as it was a couple of years ago of defaulting muni bonds left and right?
2010, there was a 60 Minutes report where an analyst, who I don't think I mentioned her name on the radio anyway, said, and actually I can say this, her business just closed. Part of her business, part of her business just closed. But she came out and says, muni bonds are headed for the second largest default besides the banking system. And she predicated this on current revenues inside the system. People in 2008 and 2009 are making less money. There's less municipal taxes around, less real estate moving around, less people paying taxes.
And you had municipalities going bankrupt.
Absolutely.
Large ones that you weren't expecting.
Exactly. These are huge. So the problem's just escalated, and she projected that there'd be, she was wrapping numbers like 50, 100 big municipal, and there were some big ones even outside the state of California. It was true. The theory was true, but I think she exaggerated it. That tanked the muni market to a tune of about 10%, 10 or 12%.
And because of what she said, or
just because of that report on 60 Minutes, and actually the time period we were in at that time was very fearful. And like you talk about risky assets, when you have risky assets, when someone thinks some of the municipality is risky, they're not going to invest in it. You don't have any buyers, like I just talked about, an inventory problem, the price just sinks. Now, some people held their money through it. They're fine. In fact, this year's another example. I mean, talking to muni managers, they're like, hey, I think the market might rally a little bit by the end of the year if the economy turns around. If interest rates don't go up, the economy turns around, people buy munis again because they don't want to pay the income tax on it.
Well, I think some people, it's kind of the lemming theory, or it's get out now before you can't get out later.
Correct. It's always out there. That's like, that's why people sometimes make good or bad decisions.
Okay, I'm going to change topics for just a little bit here. I was reading this, or actually saw this on YouTube, I think. Credit cards with radio waves on them. They're too easy to clone and steal the numbers. I don't know if you saw that, but this guy basically, if you take out your credit card, and if it has these like little lines, like radio waves, then it's encoded with a certain encryption that it's a lot easier to basically, it's a steal. Someone can, and this guy walked with, he had some kind of little device in his pocket or like in his handbag type thing, and all he had to do was get close enough to the person's purse, the lady's purse, which the credit card is in the purse. And then he basically said, hey, excuse me, is this your credit card number? And she was, oh my God, how did you get that? So I checked mine. Unfortunately, mine don't have that encryption on it. So it's just something to kind of think about, people out there. If you get these special credit cards, I mean, they're normal Visa cards or American Express, but they're these, I guess maybe they're newer, and they have these radio waves on them.
It's, I would say this, talking to people on a financial planning level, it is very challenging because they get these letters and they get new cards all the time in the mail, and they say these, the inventory of numbers have been compromised at some of these institutions that store credit card numbers for purchases. It's becoming a bigger. So all of a sudden you get this letter in the mail saying your credit card doesn't work anymore. I was like, what's going on? It's like, well, you're subject to some type of fraud or risk because your number's been compromised. This is another way on the outside where people are getting numbers. I know we had a police officer in here a long time ago said that people are scanning them. They take your card at a restaurant, they go in and they scan it somewhere in the back.
Oh yeah, I mean, realistically, all they have to tell them to do, but I mean, a restaurant employee, all he has to do is he takes your card, he takes it away, and then brings it back. How do you know he didn't just copy all the information?
Right. No, this is a disaster because it's a big part of our economy now. People don't want to carry cash. Cash isn't guaranteed. Cash can't be tracked, and people would rather use credit cards, especially in the business side.
Well,
so it's kind of frustrating.
Okay, we're going to cut to our third and final commercial break. When we come back, Mark, I think you've got some interesting real estate news for us.
I do.
Okay. Again, the theme is Jim Carrey movies. In which 2003 movie is Bruce Nolan, played by Jim Carrey, given the power of God? The first three callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. I see the eyebrows going up and down for you, Lou. I'm not sure if you know this one. Okay, the first three callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Their website is lighthouse4fun.com. Call 888-912-1190. That's 888-912-1190 to answer this question. In which 2003 movie is Bruce Nolan, played by Jim Carrey, given the power of God? Make sure to include your name, email address, speak slowly, spell out your email 100 times. Don't touch that dial. Mortgage investing, or excuse me, see, wrong show. That's the earlier one on KNEW. Okay, let's try this again. The best of investing. We'll be right back.
You guys need some coffee?
I
You guys want a
need
chai
more than
latte?
that.
Chai latte?
Rush Limbaugh will be right back.
I have never had a chai latte. I'm proud to say. I have no idea what
I
that
haven't-
tastes
yeah,
like.
I haven't
It's
done-
got to be gross. I'm
I
sorry.
think it's sweet.
Oh,
I don't drink coffee, so that's
I don't.
What's wrong with
I'll do just like the skinny mocha iced.
you? Yeah.
Yeah.
I'm addicted to coffee. I love it.
No, once you're, I know people have gone off it, or people when they get pregnant go off of it. Now,
Yeah.
I'm getting a headache.
Yeah.
Yeah, I was with a guy over the weekend. He's like, "Oh, what time is it?" I'm like, "What's the problem, man?" He goes, "I want a cup of coffee, but it's after 10. I can't have it." 'Cause I
In the
won't sleep.
morning?
Yeah, you won't sleep.
Wow.
He's pretty
I
wired
understand 10 at night, but 10
Yeah.
in the morning?
It's like, just don't. Yeah. Thanks, people in ways.
Eva can have espresso anytime and she'll go right to bed.
Yeah, pretty much me too.
Really?
Yeah.
You gotta, you know what? Maybe that's why your stomach sometimes you get kind of
Yeah.
acidic, right? Acidic.
Yeah, acidic. Yeah, alkaline, acidic, pH balance, all those things.
Like a farm system.
Oh,
Are you okay? I don't. Is this
I'm
Bruce
getting-
Almighty or no?
Yes.
We can't see in the area though. That's the one where he goes, Jennifer Aniston's tits got bigger. That's the best line.
I
My boobs get
wouldn't
bigger
say
last night.
that-
I don't know, sweetheart. Did they? That is the
Yeah, I
best.
mean, you can say, did her breasts get bigger? I wouldn't say the word tits. But
Yeah.
Sorry. Someone actually got him. He used to go, "You said shit at a party." I'm like, well, this woman was very offended. I'm like, tell her to get the shit out of her pants. I mean,
really? For nowadays for that? Okay. It's a short segment, guys.
yes. How much?
8:20.
All right. Well, you can make it, guys.
Yeah.
Oh,
Yes,
two.
we
Come on.
can.
Rally cry.
Let's just snore the whole time.
It's getting dark out, man. Where's my pillow?
That's part of the mask, like, it's getting dark, yeah. Any until any am.
It's getting dark.
Yeah. You love me. You really love me. I love that movie. Okay. Here we go. I love when the dog gets the mask. Okay. Welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Hoff of Pacific Private Money, California's fastest growing private lender, and Lou Batmale of LPL Financial, who's been quite expertise to us with his knowledge of bonds.
Yes.
Thank you very much for that.
No problem.
When we cut to the third commercial break, we asked this trivia question: in which 2003 movie is Bruce Nolan, played by Jim Carrey, given the power of God?
Mark.
Bruce Almighty.
Bruce Almighty.
I don't want to take all of them.
Okay.
It's kind of embarrassing. Just really embarrassing.
And what's your
Jim Carrey.
favorite line from that movie?
I don't want to say.
You don't
it.
want to say it. Okay. All right. Mark, give us some updates on real estate, please.
Well, it wouldn't be a Best of Investing show if I didn't have some real estate nuggets, and none of this is really news, but it's newsworthy in that it kind of, there's a complete conversation in this article I pulled off of one of the blogs that I read, and it's statistics by CoreLogic Case Shiller, which is one of the main trackers of home prices. So this is through August. We have national home prices up 10% year over year, and the highest growth rate of any MSA, major metropolitan area in the United States, was Sacramento, California.
Really?
Up 26%.
Wow.
Now, I believe that because when I was making loans in 2009 and 10 in Sacramento, a lot of my flipper clients were buying homes like crazy in certain markets, certain neighborhoods of Sacramento. They were buying homes that had appraised at prices in 2005 and 6, and people were putting these big loans on them, doing cash out financing. The depreciation in the pricing between where they were appraised at the height of the market and the prices they were buying at was at a discount of 80%. So in other words, prices had gone down. They were buying them for $40,000 and $50,000, homes that were appraising for over $400,000. I mean, just unbelievable price discounts. I mean,
And these houses weren't like dilapidated.
no, they were working class, 1,000, 1,100, 1,200 square foot homes, two ones, three ones. It's just amazing. So, that 25%, and of course other markets like Las Vegas and Phoenix were also very, very near, 24%, 23%. You're talking about, the cities that were at the center of the financial bubble of the real estate market bubble, and so really a lot of these bounce back in real estate prices, this 20%, 25% growth, was really because the pendulum swung so far.
Right, the bond market years ago.
Right, that these houses were trading at well below replacement cost, and so what's interesting and why I said this was kind of a complete article is that if you're wondering whether we're in another real estate bubble now, because we were looking at double-digit price inflation, Case-Shiller is predicting that over the next 5 years, including 2014, they're really only predicting a less than 3.5% increase on an annual basis year over year.
Sounds relatively flat to me.
Right. They're basically saying that this is an aberration. What's happened in the last 12 months is an aberration, that the next 12 months we're not likely to see double-digit growth, except in possibly other cities, not including the ones that all experienced double-digit growth this year, but that other cities that did not rise as well might see some growth.
So how does that affect your business? It really doesn't affect it much. As long as properties don't go down 80% tomorrow.
Well, Shiller did win the Nobel Prize. Let's just say that 2 weeks ago.
Is that right?
Yeah, not Case, but Shiller did. Yeah.
Huh.
Yeah. He does all the.
He probably has to share it with Case though.
Right. I had an interesting question though. So you get to places like Sacramento and Las Vegas. This is what someone told me about real estate investing down there. It's kind of captivating. Is that their newer areas are always building new homes. So let's say downtown Las Vegas, and the first 3 blocks of Las Vegas outside of there was built back in '94. 3 blocks later was built back in 2000. 3 blocks later was built back in 2005. Which home do you want to own? They're only 3 blocks apart.
2005 theoretically.
Right. Well, you want to own the one that's the newest.
Right.
That's affects the prices in some of these neighborhoods as well. Again, it gets back to inventory. My theme for the day.
Yeah, the only 2 markets are expected, according to Case-Shiller, to post double-digit gains in the next 12 months, and one of them is, again, right here in the Bay Area, and that's Oakland, which I thought was really interesting. Oakland having the largest number of single-family homes of any city in the Bay Area.
Probably because it didn't bounce as high
upward.
What do they say? The dead count. It didn't bounce back as high.
And we talked about it in older shows too. When interest rates start going up, real estate, purchases are going to go down, or refinancing is going to go down, just because apparently people are saying that's starting to happen. You think that's true? Or refinancing is going down, or people are not refinancing?
It does seem like that.
Refis are way down. Really, the future of mortgages, new mortgage originations are really in the purchasing side of it. Interestingly enough, Oakland is probably it's the number 1 city that we lend in at Pacific Private Money for our hard money loans. So most of our investor clients are buying, fixing, and flipping in Oakland, and so I find it, very interesting that they're predicting, approximately 10% gain in home prices in Oakland on average.
That could be great for Oakland.
Yeah.
Well, it's great if you're investing in Oakland. So if you're a flipper out there listening, and
live work units in Oakland.
Go chase short sales and REOs in Oakland, because it looks like your investment strategy might play well there.
We have about a minute left before we get to our thoughts of the day.
I just want to say that we've seen a really good run in the market this year, and we have not seen a downdraft. So in a normal year, the market goes up or down 15 to 20% on average. Okay. This year, we've only gone down 6%, and that was once back in the May-June timeframe. So I tell everyone to be cautious, analyze your portfolio. It might be time to take a few gains out of it, just park it and wait and do something else with it, or just markets don't usually do this.
Take money off the table, so to speak.
Take a look. If you have the opportunity, it might be time to analyze your portfolio, look at your goals, and see if you can take some profits and invest in other areas. That's what allocation is all about.
One more time, Lou. If people, I assume you'll give them free advice.
Sure.
Just look over a portfolio or ask some questions. How do they get a hold of you?
415-256-8970 or LOUISBATMALE.com.
Great. And Mark, just real quickly, people want to invest in your fund earning 8.9% currently.
Call Pacific Private Money at 415-883-2150. That's 415-883-2150, or go to pacificprivatemoney.com.
Great. All right. Thanks, guys. We're going to go to old thoughts for the day. Now, I knew I was getting old when a friend complimented me on my new alligator shoes, and I was barefoot. Oh, that stung. And when I was a kid, rainbows were in black and white. Okay, tune in next week to that was bad.
Wizard of Oz first edition.
Yes, exactly, yes. Or Mary Shelley's Frankenstein.
Yes.
Tune in next week to The Best of Investing, where we'll be getting a little older and giving away 9 more free vacations for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long.
Awesome.
You guys okay? You want an IV?